What if I told you there's a tax strategy that could save you tens of thousands of dollars or even more if you qualify? Now, I'm not talking about one of those so-called tax strategies you see online where people says to create a trust and suddenly every personal expense becomes tax deductible. That is not what this is. I'm talking about a rule that has been part of the tax law for decades. Congress enacted the passive activity loss rule under Section 469 of the Internal Revenue Code as part of the 1986 tax reform. Later, Treasury issued regulations explaining how those rules apply, including rules for certain short-term uses of property. Since then, the IRS has challenged taxpayers in court, and those court decisions help us understand how the law is interpreted, what the IRS may look for, and what taxpayers need to prove if they want to claim this benefit. This strategy can produce very large tax savings. In some cases, we are talking about tens of thousands of dollars, and in larger cases, potentially more. Does that mean the IRS is going to audit everyone who claims it? No, most taxpayers will never be audited. But when a tax strategy significantly reduces the amount of tax you otherwise would have paid, it is reasonable to expect that the IRS may take a closer look. The larger the tax benefit, the more important it becomes to make sure you can fully support the position. That is why this video is not just about how the strategy works. It is also about understanding the responsibilities that come with it. The goal is not just to save taxes. The goal is to save taxes in a way that you can confidently defend it if the IRS ever asks questions. The first thing I want to get out of the way is this. This strategy usually starts to make sense when you have significant non-passive income. By non-passive income, I mean income from a business where you materially participate or W-2 income from your job. In other words, income that is not already passive under the passive activity loss rule. How much do you need to make to even start thinking about this strategy? There's no magic income threshold, but as a general rule, I usually do not start discussing this strategy unless someone is making around $150,000 or more per year, because that is when the potential tax savings may become meaningful enough to justify the extra work, documentation, professional fees, and out-of-pocket costs needed to implement it properly. So what exactly is the strategy about? The idea is actually pretty simple. Normally, rental property losses cannot reduce your W-2 income or active business income because rental activities are generally treated as passive under the tax law. But there is an exemption. Under the right circumstances, a short-term rental may not be treated as a rental activity for passive loss purposes. If that happens and you also meet the material participation rules, those losses may be non-passive and may be able to offset W-2 income or active business income. The short-term rental rule does not automatically make the loss deductible against other income. It only helps you get out of the automatic rental passive classification. After that, you still have to prove material participation. For this strategy to work, there are two main requirements. The first requirement is that the property qualifies under short-term rental exemption. Generally, this means the average period of customer use during the year is 7 days or less. The word average is important. You do not need to limit every single reservation to 7 days. Instead, you look at the total days of customer use during the year and divide that by the number of bookings. If the average is 7 days or less, you may have met this first requirement. Now comes the second requirement, material participation. Meeting the material participation means you have to be actively involved in running the short-term rental activity. Simply owning the property is not enough. Let me show you a real US tax court case. In 2014, a taxpayer owned a short-term vacation rental in Whistler, Canada. The average customer stay was less than 7 days, so the parties agreed the property was not a rental activity and therefore was not automatically passive under the rental activity rule. But the taxpayer still lost on the short-term rental issue. And why? Because the court found that she did not materially participate in the activity. Most of the time she counted was spent reviewing reports, attending meetings, tracking expenses, and monitoring the investment, while the day-to-day operations were being handled by a management company. Additionally, the court found that she spent only about 12 to 20 hours on activity that counted towards material participation, far below the 500-hour. The court did not reject the short-term rental concept. The court rejected the deduction because the taxpayer did not meet the material participation requirement. So, what does that mean in real life? Think of it this way. If you are mostly reviewing reports, looking at financial statements, attending owner meetings, or checking on how the property is performing, those are generally investor-type activities. Material participation is different. That is when you are actually involved in operating the activity. For example, communicating with guests, coordinating cleanings and repairs, managing pricing, handling bookings, solving day-to-day problems, restocking supplies, supervising vendors, and making sure the property runs smoothly. In other words, the tax law rewards running the business, not simply watching the investment. So how do you know if you materially participated? The IRS gives us several different ways to qualify for material participation. You only need to meet one of them. If you are married and file a joint tax return, your spouse participation counts too. The tax law treats participation by a spouse as participation by the taxpayer for this purpose. IRC 469 says a taxpayer materially participates only if involved in the operations of the activity on a regular, continuous, and substantial basis. The first test is the 500-hour test. If you or you and your spouse combined spend more than 500 hours during the year operating the activity, you have met that test. The second test is the substantially all test. If your participation, including your spouse's participation, makes up substantially all the work performed in the activity by all individuals, you may qualify under this test. This can be difficult if you have a property manager, co-host, cleaners, or other people doing significant work. The third test is the 100-hour and more than anyone else test. If you and your spouse spend more than 100 hours during the year and your participation is not less than the participation of other individual, you may qualify. This is a very important test for many short-term rental owners because they may hire cleaners, contractors, but still spend most time managing the activity. But here's the catch. If a property manager, co-host, cleaner, or other person spends more time than you, this test can fail. That is why tracking both your own time and third-party involvement matters. So now, how do you document all of this? It can be a little bit tricky. But for the average day, for example, keep your Airbnb, VRBO, direct bookings, or property management bookings reports. Those reports should show reservation dates and length of each stay, making it easier to calculate your average customer use period if it is ever questioned. For material participation, keep track of the work you actually perform. Save guest messages, emails, Airbnb, or VRBO communications, invoices from cleaners, contractors, receipts for suppliers, maintenance records, calendars, pricing changes, repairs logs, and a time log showing what you did, when you did it, and approximately how long it took. The more organized your records are, the easier it is to support your position if questions ever come up. Before you move forward with this strategy, remember that material participation is just a piece of the puzzle. Your entity structure, your tax bases, the at-risk rules, depreciation rules, personal use rules, financing, and other tax limitations can all affect whether you are actually able to deduct the loss. You also need to think about the long term. What happens if you sell the property? What if you move into it? What if you convert it into a long-term rental? What if the property is outside of the United States? Those decisions can have important tax consequences. So this is a strategy you should understand before you implement it, and consult with a tax professional, of course. And note that if the property is outside the United States, the short-term rental passive activity analysis may still apply, but depreciation and reporting rules may be different. For example, a foreign use property may require slower depreciation under the alternative depreciation system, so you cannot assume the same cost segregation and bonus depreciation results you might see in a US property. If you found this video helpful, let me know in the comments. Subscribe for more.